people like Bloomberg have got no idea, actually, what the role of gold is and why it appears to be rising. It's not rising, it's their currencies going down. Now, the moment they start writing on that basis, you could see that the credibility of currencies will start disintegrating quite rapidly. And this is a very, very important point. At some stage, perhaps some of these analysts will begin to realize and put the relationship between credit and real legal money in that context. If they do, then it's going to start undermining the value of fiat currencies even more. People think, oh, I've missed it. It's gone up. So forget it. That's not the point. It's your currency going down. It's not gold going up. Gold is just over the millennia. It just goes like that. It just goes along.
Alasdair Macleod argues that once analysts recognize and report the connection between gold, credit, and real money, the credibility of fiat currencies will quickly deteriorate. He believes that this understanding will accelerate the decline in the value of fiat currencies as their inherent weaknesses become more apparent. The vulnerability of fiat currency systems lies at the heart of this dynamic. Unlike traditional monetary systems backed by physical reserves such as gold or silver, modern fiat currencies derive their value solely from government decree and public trust. This fundamental characteristic makes them susceptible to value erosion through inflation, with the potential for complete devaluation in cases of hyperinflation. This perspective reveals a more profound truth. What many perceive as an increase in gold prices often actually reflects the devaluation of their currency. The relationship between the US dollar and gold prices illustrates this dynamic clearly. When the dollar strengthens, gold prices typically face downward pressure. Conversely, a weakening dollar tends to drive gold prices higher as the precious metal becomes more affordable to buyers holding other currencies, thereby stimulating demand. According to Macleod, these analysts miss a crucial distinction between money and credit, erroneously treating the dollar as genuine money while viewing gold merely as a safe haven investment during turbulent times. The role of gold becomes particularly significant during periods of high inflation. Investors frequently turn to gold as a store of value during such times, recognizing its unique characteristics. Unlike fiat currencies, gold's inherent value and limited supply make it an attractive hedge against inflation. This relationship has been demonstrated repeatedly throughout economic history as investors seek to protect their wealth from currency devaluation. Before we dive deep into this video, please subscribe to our channel, hit the bell icon so you never miss an update, and share it with friends who may benefit from it.
They think that the dollar is money. So they're looking at gold as an investment. They're speculating that gold will go higher because of demand, whatever. They are not looking. They're not putting into this any credence for the difference between money and credit. They think that the dollar is money. They think that gold is something sort of out there which, perhaps gives you a bit of comfort when things start going wrong. And they see heightened risk. So when there's heightened risk, they think the gold price goes up. What they don't understand is it's their currency going down. And this is the problem actually throughout also the whole of the banking system and derivative markets. And it's, a lot of it's because they have to account in dollars or pounds or euros or whatever their national currency is. And so, a good year is one where you've got a profit in pounds or euros or dollars. So you tend not to look at gold other than through these blinkers of your P&L account in fiat currencies. And so people like Bloomberg have got no idea, actually, what the role of gold is and why it appears to be rising. It's not rising, it's their currencies going down. Now, the moment they start writing on that basis, you could see that the credibility of currencies will start disintegrating quite rapidly. And this is a very, very important point. At some stage, perhaps some of these analysts will begin to realize and put the relationship between credit and real legal money in that context. If they do, then it's going to start undermining the value of fiat currencies even more. People think, oh, I've missed it. It's gone up. So forget it. That's not the point. It's your currency going down. It's not gold going up. Gold is just over the millennia. It just goes like that. It goes along. I mean, I had a look at Diocletian's Edict of Maximum Prices, which was 305 AD, round about, give or take a year. And there are quite a lot of things in there which are priced exactly the same as they are today in gold, because he put in the relationship between gold and silver, which incidentally was a gold-silver ratio of 12, for those that are interested. I think quite a lot of commentators sort of took the view that Russia would immediately change everything and bring in this, that, and the other thing, and we notice huge differences. I think the principal difference, and this is something which obviously, was practical, was instead of trying to integrate a whole new raft of BRICS members, they created an associate membership category, which allows potential members, if you like, people who have expressed an interest in becoming part of BRICS, to, if you like, go into a sort of waiting room while the integration process for them develops. And this is something which isn't necessarily immediate. I mean, it could take several years. And the idea also that they were going to immediately do away with the dollar, no, that's going to be a long, long process. I mean, it's an evolutionary process, if you like. And it's sort of the idea that the Russians could sort of suddenly change this, I think was actually stopped in 2023 when the Russian embassy in Nairobi floated the idea that a gold-backed trade settlement currency would be on the agenda in Johannesburg. And it didn't make the cut. Why? China didn't want to, if you like, upset the world, upset the entire fiat currency system by backing this. India certainly didn't want to do it. India is Keynesian to the core. So the idea of going back onto a gold standard, if you like, would limit the Indian government's ability to manage its own economy very substantially. And not only that, but I mean, they've spent all their time trashing their population for being gold friendly, because as far as they were concerned, these were imports which were completely unnecessary, and without it, India would have had export, net exports, whatever. I mean, basically they're anti-gold. They're now accumulating gold because they have to. And I think also the other thing which is actually important in terms of BRICS is that the BRICS membership, of course, they talk to each other a lot, at government level and also at central bank level. And I think they're generally agreed that the West's fiat currency system is on its last legs. And that's why these central banks are aggressively accumulating any gold that they can get their hands on.
Macleod notes that China and Russia are encouraging central banks to shift from US dollars to gold, recognizing it as real legal money. China's sale of dollars for gold exemplifies this. As US debt to GDP is expected to surpass 150%, foreign investors are swiftly exiting dollar assets due to concerns over rising US debt and the dollar's weakening value. According to the World Gold Council, central banks, particularly China, demonstrated unprecedented interest in gold during 2023, purchasing 1,037 tons. The People's Bank of China led this charge, acquiring more gold than all other central banks combined. This momentum continued into 2024, with central banks accumulating 290 tons in the first quarter alone, marking the fourth strongest quarter since this trend began in 2022. China maintained its position as the leading buyer. Recent World Gold Council data from September, drawing from sources including the International Monetary Fund, reveals the substantial gold holdings of these major powers. The Russian central bank maintains 2,219.2 metric tons of gold, while China's reserves are 1,936.5 metric tons. Despite this disparity, both countries are pursuing strategies to reduce dependence on a dollarized global economy, with gold playing a central role in their approach. Let's get back to the video.
Well, it's very, very simple. It's not gold going up so much. It's more a question of currencies going down. This idea that when you get a recession, inflation disappears is complete nonsense. This is what everybody's been expecting, that we've got a soft economy and the economy is not really growing and therefore inflation's going to disappear. I mean, it's complete nonsense. It doesn't happen like that. You have to understand that inflation as such is not inflation in a sensible definition. I mean, originally the definition of inflation was a monetary thing, not a price thing, for a start. And secondly, it doesn't actually capture what's going on. I mean, what is happening is that the purchasing power of fiat currencies is declining. And part of that has got nothing to do with changes in the quantity of credit in the system. In these times, it's got a lot more to do with the confidence and the faith in that currency. And so if you look at what the People's Bank of China is doing, I mean, this says it all. They've been, you read the press, they've been buying gold. No, they haven't. They've been selling the dollar. So what do they sell the dollar for? They sell it for real legal money, which is still legal money and real money by common law, despite of everything that the Treasury, US Treasury, has been trying to tell us for the last 50 years. So, the Chinese aren't convinced by that propaganda. And they know that with the US in a debt trap, I mean, last time we talked, you sort of questioned, are they really 135% debt to GDP? I mean, the answer is yes. And it's going to get worse because if the economy tanks, if the economy goes down, then that ratio shoots up. And it won't be very long before you see a debt to GDP of 150, 160%. So what do the foreigners do? They just get the hell out of it. And the foreigners own roughly $32 trillion of dollars and financial assets denominated in dollars. So, they're up to their necks in this. And not only that, but they're all the sort of, if you like, the temporary positions that occur in the foreign exchange markets, which according to the Bank of International Settlements adds another 80 trillion or something to the foreign-owned total. Exposure to a collapsing currency is absolutely huge. And this informs the deep state, the deep financial state, if you like, in China and Russia. They can see what's going on. And that's why they've told everybody, for goodness sake, protect yourselves. Go out and buy some gold. So you've got all the central banks and even the Polish central bank, who are probably sort of listening in, if you like, buying gold. What are they doing? They're actually adjusting their reserves. They're getting out of fiat and they're going into real legal money. And that's a process which is going to continue. And I think so acute is the problem. I mean, the only G7 countries which don't have debt to GDPs of over 100% are Germany, which is where you are at the moment.
62%.
And Canada. Canada's rapidly going downhill, and Germany, unfortunately, is as well as a result.
We're not far behind,
let's not go into that. So, you've got, what have we got in 2025? We've got the potential for these debt traps really to be sprung on major currencies or the governments that are responsible for major currencies. You've got central banks which are insolvent. I'm not talking about commercial banks. The central banks are insolvent. They're insolvent in the sense that their debts exceed their equity many times over, many times over. Now, that can be recapitalized, but you can't recapitalize the ECB. I mean, that's virtually a no-no because it's a two-step process and it requires agreement in multiple jurisdictions at the political level.
Gold is gaining recognition as a stable store of value amid challenges to fiat currencies. With rising U.S. debt and declining confidence in the dollar, central banks are turning to gold to protect against currency devaluation. This increasing demand underscores gold's enduring role as real legal money, offering security in uncertain times as countries reduce exposure to a fragile financial system. Do you think gold will replace fiat currencies in the future? Share your thoughts in the comments below, and if you enjoyed this video, don't forget to like, subscribe, and hit the notification bell for more updates. Thanks for watching.